Hello, my fellow investors, and welcome back to another earnings report as well as stock analysis video. The madness when it comes to earnings continues onto this week, where we're going to have a lot more companies, guys, and we're actually going to do a live stream tomorrow, Wednesday, and Thursday covering all the madness for these companies. So for now, because it's Monday, as if I'm recording this, there really isn't that many companies that are releasing earnings that people, I think, would like. However, SoFi did have earnings today, and I figured let's cover it because this is a company that has been through a lot, and well, a lot of people got into it thinking that they were going to go to the moon, and they're far from it actually. So let's cover this and see what we can learn from these fundamentals. So with that said, let's get started with this analysis. So guys, let us get started with their earnings summary. Here on Seeking Alpha, we got EPS normalized actual came in at -4 cents, which is a beat by 4 cents. EPS gap actual -5 cents, beat by 3 cents. Revenue $460.16 million, which is a beat by $23.38 million. So everything here was in the green. However, the fact that they're just beating analyst estimates doesn't really tell us much of anything. So let's dive now into their actual earnings release. And like always, guys, this will be linked in the description below for everybody to see, as well as all the calculators that you're about to see in this video will be available for you as well, all for free. So highly suggest, guys, when it comes to investing into a volatile company, a stable company, an IPO, please do your own due diligence. Please do not take this video as due diligence, because it is not. I go over things in a way that you can kind of get the general gist of it, but it is not a full deep dive. So please make sure you do your own due diligence and make sure you read their financial statements and make sure that you go to a trusted financial advisor, which I am not of, and you get some real financial advice from somebody who is licensed when it comes to doing this stuff. So with that said, let's actually get started with SoFi's Technology Incorporated reports first quarter. Record GAAP and adjusted net revenue for the first quarter of 2023, GAAP net revenue of $472 million, up 43%, 416 adjusted net revenue, up 43% year over year. So right there, and this is exactly what I'm talking about. It was a beat, right? It was a beat by not a lot though. The beat was only by 4 cents and 3 cents. When you see that, you're like, oh, okay, at least, it's in the positive, but it's not looking that good. However, the fact of the matter is that they beat by 43%, which is not a small number at all. Record adjusted EBITDA of $76 million, up 772% year over year and up 8% sequentially. New members add of over 433,000, quarter end total members up 46% year over year to nearly 5.7 million. New product ads of nearly 660,000, quarter end total products up 46% year over year to nearly 8.6 million. Management raises full year 2023 guidance. So everything here just sounds like amazing. However, well, when you guys show you guys this company's overall graph in the past, no, since they IPO'd, no, well, unfortunately, it's not that good of a graph, unfortunately. But we'll get to that when we get to that. Now, let's take a look at what the CEO had to say. Quote, "We delivered another quarter of record financial results and generated our 8th consecutive quarter of record adjusted net revenue, which was up 43% year over year. We also generated our 3rd consecutive quarter of record adjusted EBITDA of $76 million, representing 48% incremental EBITDA margin and a 16% margin overall, as well as a 54% incremental GAAP net income margin," said Anthony Noto, CEO of SoFi Technologies. Quote, "Strength across all the 3 business segments, lending, technology platform, and financial services drove these record results." And don't get me wrong, guys, that's actually a really good overall growth. Now, let's actually come over here to the consolidated summary, and we can see that the revenue, well, in the 3-month ended for 2023, guys, 472, I believe this is in thousands, so this is 472 million if I'm not mistaken when it comes to this, and in 2022 it was $330.34 million. That's a change of 43%. Now when it comes into the next one, guys, the net loss, we can see that it's still in the negative, but it's actually getting closer to the positive. 2022 was negative $110.4 million, and in 2023 it went up to negative $34.4 million. That's still a decrease of 69%. And when it comes to the loss per share, basic and diluted, we got negative 14 in 2022 to negative 5 in 2023. And well, looking at the non-GAAP, we can see that the adjusted net revenue $321.7 million, and in 2022, $460 million is still an increase of around 43%. And now something else I also want to point, guys, it is in regards to their free cash flow. Now, you all know I harp about free cash flow because, once again, free cash flow is everything. And unfortunately, this company does not tell us the free cash flow, and it even doesn't tell us the capital expenditures either, which is kind of disappointing, honestly. But honestly, we don't really need to even take a look at the CapEx. Looking at page number 15, we can see that the net cash used in operating activities, well, guys, it's actually gone even more into the red. Like in 2022, I believe this is what, $1 billion in the red. Again, this is in thousands, so normally when it's in thousands, this number over here is the thousands, so this would be the millions, and then this would be the billions. So I'm fairly certain that this is $1 billion in the negative, and in 2023, it went down to negative $2.2 billion. Obviously, even if this is not the way that I'm saying it, let's say that this is 2 million, well, it would still be a massive drop, guys, going from negative 1 million to negative $2 million. So I think it is in the billions. Nonetheless, though, the main crux of this is the fact that, well, you know, it's just going down further and further down. Net cash used in operating activities, i.e. cash from operations, it's going down. So you subtract the CapEx from this, and this will just get further and further into the negative. So that's not something that you want to see when it comes to investing into a company, guys. So with that said, let's jump now into the calculator. We got the ticker for SoFi, market cap of $5 billion, a PE of NA, and the reason for this is because of the fact that, well, their earnings are in the negative, their net income is negative, so that's the reason why. Current share price of $5.47. Now, this share price, okay, this share price, it's interesting because this was one company that was, I wouldn't say it was too hyped during 2020 and 2021, but it was one of those. It really, really was. And looking at this graph, guys, on the 1 year, you can see that they're down 13.6%. Year to date, they're up a whopping 21.56%. Looking at this, as of January 3rd, they were as low as $4.50. Now, that's actually not even their 52-week lows. $4.24, that was a 52-week lows, and the 52-week high was only $8.52. Now you're looking at this and you're like, well, you know, that's not too bad, it's still single digits. Yeah, except if we actually put this graph on the 5-year, we could see that this thing, I mean, I don't know any technical terms, but I'm pretty sure that this would classify as like a W pattern, I think. You guys can see here on the 5-year high, this thing went as high as what, $23, I would think. Actually over here, $25 as of January 29, 2021. So yeah, this thing has fallen a significant amount. To those people who say, yeah, but on the year to date, see how high it is, great. But if you invested in this thing back in 2021 thinking it was gonna go to the moon, well, you are very, very far from the moon. Now, this is not the worst one that I have seen, right? However, a lot of people that bought into this company thinking that it was going to go to the moon, it did not. So let's see if, looking at the fundamentals, we could have possibly evaded all of those losses. So coming further, we can see that they don't pay out the dividend. So, okay, that makes sense. You know, they just went IPO as of what, 2021, if I'm not mistaken. If we look at this back, yeah, actually, no, 2020, November 30th, 2020 is when they IPO'd. And, well, guys, looking at these free cash flows, negative 1.67 billion being the average in the past 5 years, down to negative $7.35 billion just last year. So this thing is getting further and further in the negative. And on top of that, I mean, we just saw that in regards to this net cash and use operating activities. Negative, I'm pretty certain that this is in the billions now. Negative 2 billion in 2023, and in 2022, it was 1 billion. So yeah, guys, this thing is getting further and further into the negatives real fast. So let's see what the fundamentals have to say. And of course, starting off with the net income, we know that this thing is pretty bad. Now, it actually is kind of disheartening because we could see that 5 years ago it was negative $252 million to 1 year ago of negative $320 million. You can see from 5 to 4 to 3 actually consistently increasing. And, well, when COVID hit, guys, that was 3 years ago. It was going up. And then 2 years hit. This was 2021. And this thing just collapsed down to negative $484 million. And as of 1 year ago, it has come back. Now, my issue with this is so this is per year, yet they IPO'd in the end of 2020. So right here. So I'm not really familiar when it comes to IPOs because I don't like to invest in IPOs. I like to wait for a company to actually show me that they're worth something, because then, well, you don't get that massive collapse going from $25 all the way down to like $4. So yeah, I'm not fairly certain if these prior numbers are taken also from prior to IPO. I know companies obviously have net income prior to IPO, but are they taken from that, or at IPO, does it start counting the fundamentals from that point onward? I'm fairly certain. Again, I do not deal with IPOs. I try not to deal with IPOs for this exact reason. They're way too complicated. I think that regardless of the fact is that these 2 years ago is taken from before the company even IPO'd. Nonetheless, though, guys, this is still a massive decrease of 27%. And I mean, it's constantly in the negative. We saw a massive just spike down right over here. So I am going to give this at around like a 30, I would say like a 25% or so. Looking at the free cash flow, this one is just horrendous. Like, really horrendous. We got 5 years ago of a positive $1 billion, great, and then 1 year ago negative $7.35 billion, decrease of 828% with an average of negative $1.67 billion. Now obviously this graph is looking bad because, I mean, you just have to look at it. For anybody who's listening, well, it is consistently decreasing. It was 1 billion 5 years ago, negative 92 million 4 years ago, then negative 503 3 years ago, negative 1.4 billion 2 years ago, and then a whopping negative $7.35 billion as of 1 year ago. So this graph is just horrendous. Massive spike down here from 2 to 1 year ago. I have to give this a 0%. Looking now at the revenue. This is a growth company, so not surprising that we're seeing an amazing revenue. $269 million to $1.52 billion, increase of 464%, guys, consistently increasing. It's looking a little bit hyperbolic over here. However, you know what? I'm going to give them the benefit of the doubt, and I'm going to give them a 100% when it comes to this one, seeing that even in their earnings report, if we take a look once again at their revenue, we can see that it is still consistently fairly increasing, going from $330 to $472 million. Going from 2022 to 2023, increase of 43% as we saw. Nonetheless, though, again, 100%. Okay, it's good, but one of the three metrics, guys, doesn't cut it. Looking now at the assets minus liabilities, also caught me by surprise. Really nice, consistent increase overall. I like it. No massive spikes, not even a little dip here and there. It's fairly consistently growing and in the positive as well. Average total assets, it is $12.61 billion. Average liabilities is $8.4 billion. And doing this difference, we get $4.2 billion, guys. I'm going to give this thing, I would say, at around, well, I honestly, no, I'm gonna be true with you guys. I'm gonna give this a 100%. This graph looks really, really solid overall. Now, looking at the cash flow minus the liabilities, not as bad as you think. So we got fairly consistent negative difference, even with the cash flow decreasing, which is actually kind of surprising. All except for 1 year ago where they just shot massively down, probably because of the fact that their cash flow just dropped instantly. But aside from that, you can see that even with the cash flow decreasing at a not a massive rate, but just like a really steady rate from essentially 5 to 2 years ago, it didn't fall under what, $6 billion, like at all. Sorry, negative $6 billion. So it's very, very interesting to say the least. And it's unfortunate that as of 1 year ago, it's negative $20.8 billion, almost negative $21 billion. Guys, their average is negative 8.7. So I'm actually going to give this at around like a 15% because, well, from 5 to 2, it's looking all right. But that 1 year ago is just so close to today, it freaks me out. 15%, I would say. And now for the silent killer when it comes to investing, and the thing that just made me oh my god, it made me do a double take, and I just hit my forehead when I saw this, because this is just insane. I get that it's a growth company, but guys, this amount of dilution, I mean, It's just insane. We got 5 years ago of 35.1 million shares. As of today, 934 million shares. That is an increase of 2,561%. I'm rounding up. To be exact, it's 2,560.68%. Guys, in 1 year, from 2 years ago, 828.2 to 1 year ago of 933, that is an increase of more than 12.75%. This is massive dilution to no end. And this is exactly what a lot of people don't tend to take a look at. And it's the silent killer. It really is. Now, I get it. They're building capital, right? They're a growth company. Okay, great. Awesome. They want to make money one way or another. They're clearly not making it to do free cash flow. So what are they doing? Well, they're issuing shares. They're issuing shares, especially after the fact that their shares went to $25. They probably saw that and they were like, oh no, no. Right, 2 years ago, right? 2021, boom, right there. Oh no, we are just going to just issue so many shares and just make $25 on these people that apparently just keep buying it for some reason. So yeah, you know what? Screw them. We're going to dilute them. Eventually, we'll buy them back once the stock price actually comes down to a price that we actually like. So massive share dilution, guys. And it's unfortunate, but I'm going to have to give this thing a 0%. This is awful. Now, lastly, we got the cash equivalents. Currently hold $1.42 billion, an average of $839.28 million. Looking at the overall grades, we give an income of 25%, free cash flow 0%, revenue 100%, assets minus liabilities 100%, cash flow minus liabilities 15%, shares outstanding of 0. Overall grade of 37. I mean, honestly, I would have just stopped at that free cash flow. Like, I wouldn't have wasted my time. But for video purposes, I would, obviously, I'm going to go through the whole entire process. But just let you all know, I would have definitely stopped at that free cash flow. So now let's actually see if at the current share price of $5.47, this is looking like a buy. Now, you guys are looking at this and you're like, oh my God, with nothing input, it's already $69. This is an absolute buy. Okay, but the problem with this thing is that, well, unfortunately, guys, we have a major problem with share dilution here. So that's going to be something that I'm going to have to put a massive number here. And you guys may disagree, but I'm actually going to tell you guys exactly why I'm going to put these kinds of numbers. Now, with the revenue growth assumption, okay, we saw that as of the earnings that their revenue, total net revenue, grew 43%. Okay, great. Now, Seeking Alpha is actually telling us that the revenue growth forward is 34%. So fairly close, right? Fairly close. So let's actually go with that, right? Let's say the worst assumption, let's put it at around like 30, let's just say 33%. Let's increase this by 4 and let's say, or should we increase this by 5? Let's say this at 38%. Okay, and another one by 5, that'll be what, 43%, right? So essentially the highest one would assume that this company would continue to grow this net revenue as we just got in their earnings report. And the lowest one would assume what Seeking Alpha is saying. Okay, now you guys are looking at this, you're like, $200? Oh my God, what a great buy. So now let's put in the shares outstanding. I mean, so in the past 5 years, they diluted more than 2,000%. And I'm going to put some numbers here. And I already know people are going to disagree, but I'm going to tell you why exactly I'm putting them. So 2,000, I'm actually going to be a little bit nice when it comes to this. I'm going to say 1,000 for the lowest assumption. Okay, let's go down by 50. Let's go down to negative 950 for the median, and let's go to negative 900 for the highest assumption. And well, with this, guys, we get the target share prices of $2.43 to $4.07, not adjusting for debt, and then adjusting for debt $2.40 to $4.02. Margin of safety of 5, 10, 15, $2.04 to $3.82. Now you guys are looking at this and you're like, that's insane. They will not do that. They just can't. They will not continue to issue shares. No, that's not possible. So here's my rebuttal to that. Guys, they have no free cash flow. Okay, sure, they have a revenue. I understand that, but that's their bottom line. Their top line, net income, their free cash flow, it's not good, right? And free cash flow is what companies use to do everything: make acquisitions, grow the company, buy back shares, issue a dividend, and what else is there? And just overall grow the company, right? And pay down debt. So they have no free cash flow, right? And this is not a case that, oh, they have positive cash from operations, their capital expenditures just goes all over the board. No, this is a case that if we take a look at this, guys, look at this cash from operations. 1 billion 5 years ago, negative $54.7 million 4 years ago, negative $479 million 3 years ago, negative $1.35 billion 2 years ago, and negative $7.25 billion 1 year ago. Their cash from operations going further and further and further into the negatives. And then on top of that, well, also increasing capital expenditures. Now, the capital expenditures hasn't gone too bad. That's beside the point, though. Guys, this cash from operations is horrendous, okay? Horrendous. So you can't tell me that they aren't going to continue to issue shares at a massive rate. They need to make money. The one way to build capital, it is through selling shares. Guess what? They have had a tendency of issuing a massive amount of shares in just 1 year. Actually, just 2 months after they IPO, they issued all those shares, probably because they were like, what? Oh my God, look at this. Our stock price is going all the way up to $24. This is not worth $24. Let's issue shares, as I said. So who's to say that that's not going to happen again, right? Who's to say if a company is really, really struggling, they're going to issue shares to come up with some kind of capital. So I'm going to stick to my guns here, and I'm going to say negative 1,000, negative 950, and negative 900. Guys, these are the numbers that I get. So if you guys believe it, great. If you don't believe it, great. At the end of the day, as I said, this is not financial advice. Every investment is the present value of all future cash flow. So I'm just trying to be conservative and logical when it comes to these kinds of companies. Fact of the matter is that if I would have said that this company should be worth around $4 at the highest, adjusting for debt, and even not adjusting for debt, at around this peak over here, a lot of you guys would have said, no, you're wrong, no, you're wrong. And as of today, they have fallen down a massive amount. In fact, just the intraday, I didn't even show this. Intraday, this thing has fallen 12.2%. So at the end of the day, you know, believe what you guys want. Obviously, I'm not here to try and convince anybody. I'm just doing this for entertainment purposes and to show you guys at least what kind of process I would use to screen out companies like this. I personally wouldn't even have gone this far. I would have just stopped at the free cash flow. They'd be like, nope, decreasing free cash flow, nope, out. So if you guys are, you know, not agreeing with me on this, understand that, well, I mean, let's face it, the fact of the matter is that they fell from $24 all the way down to $5.47. Actually, no, it wasn't. It was $4.24. So do that information as you will. Not financial advice. Have all these calculators, guys. The earnings report will be in the description below. And make your own financial decisions for yourselves. So, all in all, when it comes to SoFi, I am fairly certain a bunch of you guys are going to disagree, and that's perfectly fine. Thank you for watching. You know, I'm pretty sure one of you is going to nitpick on something really tiny I got wrong, probably in regards to like, is this in the thousands or is this in the millions, like when I was reading the earnings report. But if that is the deal breaker for you guys into like tell me, oh, you know, oh, you're wrong about this, well, understand that once again, this thing did fall from $25 roughly to sub $5 in the span of what, 2 years? So it is what it is. Anyways, guys, that pretty much is for this video. Like if you like, comment, subscribe. If it does help with the algorithm on YouTube, you all can follow us on these sites. A link is in the description below. So with that said, peace out, and we'll see you all